Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, April 14th, 5:16 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the big show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what you need to know for next week, and update the world famous 21 over 21 leaders list. Let's get right into it. State of the market, we've changed it slightly. I talked in last night's video about how industrials were acting better, and we wanted to see the reaction to the big financials reporting on Friday morning. Bottom line is we've changed it from avoiding real estate, financials, and industrials to just avoiding the regional banks and real estate, as industrials closed above the 21-day moving average on the week, and the big banks uh, looking fine, meaning the X and got the XLF, the big ETF, back above its 21-day moving average. KRE and KBE rallied into their declining 21-day moving averages and failed there. So for now, we're pretty much saying you would want to stay away from the regional banks and watch how they respond to earnings. JP Morgan just knocked it out of the park with record revenues, but KRE started green on the back of that and reversed and closed down 2%. That's not what you're looking for if you're looking for leadership. So avoid banks and real estate. Real estate, we're thinking we are going to take that off, but the XLRE and IYR broke decisively below their 21-day moving average today, down 1.7% on the day. So it's an uptrend, but you got to pick your spots. Mid caps, small caps, generally weaker than large caps, and the sectors that we mentioned. So let's check over here. We downgraded leaders. I don't have no confidence in leaders. They're holding up but not making progress. Basically, staying in line with the S&P 500. That's not what we want out of leaders. We want them to do what they usually do, which is outperform the market by a factor of 2 or more. And if they're not doing it, and we're not putting money to work on strength, but rather suggesting that buying them on a pullback and selling them when they show strength, that's no way to be confidence in leaders. So although we've got stocks for the 21 over 21 list, it's very rare that a stock is knocking it out of the park and continuing to go higher. There are a few like NVO and like ELF, but for the most part, it's a slow slog. So downgrade to neutral on market leadership. Short term, we're at bullish slash uptrend for the 5 indexes above the 21. Small caps are the laggard. Medium term, got the big cap indexes above their 50-day moving average. Mid and small below. Long term, the 3 big cap and now joined by mid caps to close the week above their long-term 200-day moving averages. Small caps continue to lag there also. So it's you got to be really the most success that we've had. I've been saying this the last really about the last week, is large cap indexes. They're difficult to beat with any individual name at this point, and that's the market that we have. So what just happened today? Um, mixed open, and then some strength out of the gate to tack on to yesterday's nice move. Gave the bulls some reason for optimism. That stopped within 30 minutes after the open. Hard reversal, trend lower. Looked like we were falling apart. A full 1% reversal from high to low. And then some buyers came in down around the 41.13 level, and by the end of the day we were able to reclaim that key level that I mentioned yesterday, 41.30. And oddly enough, let me verify this. Yeah, we closed like flat after hours. So both on the Nasdaq down slightly, the S&P 500 basically closed at 41.46, which is where we opened today. So at least we've got 0.2% to the good for the open of the futures Sunday night. So here are the final numbers. Our RG7 Revere Growth 7 ETF composite down 0.5%. S&P down nearly 1% at the lows. Closed only down 0.2. NASDAQ 100 down 0.2. Dow, and the NASDAQ 100 was the weakest, was weak all day relative to the S&P, so it really closed the gap late in the day. Dow down 0.4, mid caps down 0.5, Russell 2000 small caps down 0.9, global diversified 60/40 down 0.34. Bonds weaker than stocks again today as interest rates continue to rise, which is again kind of odd since we're looking at the Fed ceasing raising rates. In-house GROTECTION down 0.24%. And I've got a case of the yawns right now that I'm trying to get over. It always happens when I start these videos. And then we'll get to the tail of the tape and the updated 21 over 21 leaders list. Reminder of two changes that we've done to our format. We're going to, on Tuesdays, update it'll be Tuesday Titan 25, the 25 large cap stocks that are the key to the big three major indexes. As long as those are holding up okay, the market's going to hold up okay because of their heavy weightings. So you want to pay particular attention to those, in addition to the normal attention that we pay to leading stocks. And then Wednesday will be weekly chart Wednesday, where we'll focus more on zooming out and get a bigger term, longer term view. A lot of good stuff to be gained by making sure you keep the weekly chart in mind when making decisions. So let's get into it now. We'll start off, as we always do, with a chart of the S&P 500, quickly explain why we do what we do. At Revere Active Management, we're looking to keep our clients, a great number of which are approaching retirement, from having to deal with any of these severe bear markets as they approach retirement. There's a concept called sequence of returns. You never know from year to year what returns you're going to get out of the S&P 500. You know, over the long term, it returns 8 to 9%, but there are a lot of intermediate term and even short term uh, difficulties that you can certainly address. And sometimes you just don't have the time to recover from those. You can see in shaded severe bear markets. We just had one with COVID down 35% in 5 weeks. I often ask people who they say, "Oh yeah, well we came back." Well, suppose the death rate for COVID was like 4%. Where would the world be right now? I can't answer that question. I have a feeling that we wouldn't be where we are now with the indexes. And then the great inflation sell-off of 2022 down 27.5%. We were down less than half of that. Struggling to stay up with the indexes this year as the turn was made in the indexes, but the turn is especially over the last 2 weeks, not including leading stocks. So we're righting the ship to get in line with what's going on with the market, focusing more on some different sectors that are acting well and the large cap indexes. And if you're interested in this approach, reach out to us. You can reach me, Don, at revereasset.com, or the phone is 855 Real Wealth. That's 855-732-5932. Here's a chart of the S&P 500. Let's go to the 5-minute chart, and you can see the fun of the day. So there's a strong trend up close after the PPI data yesterday, after a very volatile Wednesday session after CPI data. Today, little gap down, strength right out of the gate. Looked like we were going to continue the breakout, I should say, as we broke above that 41.40 level at the close yesterday, but we started to pull back very quickly. I think it had something to do with slightly after the consumer confidence data came out, we started selling off, and you can see this was as strong an uptrend that we saw yesterday afternoon. We saw just as strong a downtrend off of that high, going all the way down to 41.13. But hey, that held the breakout level of yesterday morning. We tried to rally, failed, tested it again, and held it. Then we got back to this key 4134-ish area. Tried to get above it, couldn't get above it. Sold off again, but made a higher low. So then we've got higher lows. Can we make a higher high? Yes, we did into the close up to 4140 and actually closing at 4146 ish on the day, right to where we stopped on closed on Thursday. So that really keeps the breakout intact. If you want to see on a 60-minute chart, I mentioned last night, this 4134 area was where we wanted to reclaim. We reclaimed it by the close. But we're back above it even more after hours. We'll see if that is going to stick when we get to the markets on Monday. So um, this consolidation area, 4133 at the top, 4070 at the bottom, trying desperately to break out of it with leadership by big cap stocks. So there's the S&P 500. Let's go to the Nasdaq 100, which has been showing relative weakness over the last 3 weeks. A little bit of relative strength toward the end of the week, really just consolidating above this pivot 313.68, which was the breakout of this flat base. And there's also a key level 315.59. We've been talking about that for months. Today's low 315.61. That's a key fib retracement area from COVID and the high to low from the post-COVID rally. 38.2 retracement of that, and the algos know that. And buying comes in. It's just not a coincidence that there's so much action that takes place around that area. Very similar to what's going on around 41.55, which is a 50% retrace of the bear market. 41.98, which is a key fib level off of the COVID rally. Also, these have marked highs and lows and resistance and support areas all during the attempted recoveries for the various indexes. So here's the NASDAQ 100. We came off of overbought, but we got the stochastic hook back up. That's good stuff there. Let's go to the Dow, which continues its leadership over the last 2 weeks, not so much the last 2 days, but uh, near these highs, this several month period of underperformance because of some medical stocks. Well, medical stocks have the wind at their backs now, despite UNH being down 2.7% on earnings today. That's why the Dow lagged, being down 0.4%. But um, that chart's still looking good. Let me look at that real quick because I don't want to bypass it. Beautiful bounce over the last 2 weeks, starting with this nice gap up. I think this was on an upgrade on 4-3, uh, back above the 50-day, back above the 200-day. Normal pullback here to the ADMA and the 200-day moving average. It's one of those Titan 25 that we're going to be keeping our eye on because it has it plays such an important role in the returns of the Dow. Its return is equal to the second and third ranked stocks combined. So here are mid caps consolidating the last 4 days after getting back above the 21 and the 200-day moving average on Monday. So some good stuff there. IWM, this is where the problems continue. Consolidating the last 4 days. Big outside range today. We showed some strength early, gave that up. Above closing basically right on the 21, but below the 50, below the 200. And this is just a mess here. We're going to need some earnings, some positive earnings to get this out of the malaise. So there's the major indexes. Now the dollar, which has been weak lately, dollar got a big bounce today, up 0.58% after 3 gaps down, but that was just enough to bring it back into the declining ADMA. It failed into the declining 21 EMA on Monday. And this has been playing a key role, the dollar strength and or weakness on precious metals. So gold gap down today, finished off the lows, still hasn't touched the 21 on its pullback, down 1.8%. GDX gold stocks were down much worse, bounced at their ADMA down 2.2%. Silver was green early, then sold off, bounced at the ADMA down 1.8%. Normal pullback in context, but this isn't going to hold the ADMA forever. So keep that in mind. That the ADMA, 1, 2, 3, 4, 5 weeks above it. That's 20 sessions. above the 80 MA. That's long in the tooth, but um, you choose to follow the trend and you pick what time frame you want to follow it over. So that's an individual decision. Let's go to the VIX. Despite the sell-off during the day, the VIX was down most of the day. Market down and VIX down, and this especially happened um, later in after lunchtime. VIX just started selling off, and then the market wasn't really bouncing, um, but then it did, and close, as we said, the nice close. But VIX red while the market's red always gives you a glimmer of a hope that the market can reverse, and that's what we saw today. And this on a daily chart is new closing lows, 1707. Okay, 1706 was the low here, but not the closing low. So new closing lows going as far back as this chart shows. Um, People think the VIX is broken, but what it is a measure of forward volatility, and we haven't, despite the bounces, volatility on the S&P is coming down. It's come down over the last 3 weeks from 1.5% a day to 1.36% on the day. Shrinking volatility on the S&P is typically consistent with the S&P 500 going higher, and that's what we've been seeing. Let's flip over to bonds now. BND down 0.5% on the day. Bonds pretty much across the board. Prices were down, which means the yields were higher. So we broke below a 4-day um, consolidation, made lower lows on the price. TLT breaking the 21 into the 50-day moving average here, heading from a failed breakout down to the bottom of the range, which means a false breakdown in rates. You can see here, and then up all week, trending higher into the 50-day moving average. So for now, we thought this was a false breakdown. We tested it again and bounced at that level. We can go from 37, 39 where we closed up to this 40 level, which was the island top that we saw here back in the beginning of March. Let's flip to the 10-year now, the TNX. 10-year up 2% on the day because the price of the IEF was down. This is the 7 to 10-year down 0.5%. So also breaking the lows of the last 4-day consolidation. Let's go to Bitcoin, which was having a nice week consolidation on the week, up 8.51%. You can see the breakout here, which happened the week of 317. Some consolidation and then making a higher high right into this area here, which should provide a lot of resistance. So if you look on the daily chart here, that's back in here where we had a big gap down on in June of 2022. I think that was related to one of the exchanges blowing up or one of the crypto frauds. To me, they're all garbage except for Ethereum and Bitcoin and some of the stable coins. But I would personally invest in this if it had a healthy chart. I know a lot of people that wouldn't, but that's what makes the investing world go round. Okay, let's get to the tail of the tape now. You can pause it to read the whole thing. I'm going to hit the highlights. The news: retail sales were weak before the open. Our day count from up one to up one with one consolidation. Plus 15 on the ADMA and 21 EMA count on the S&P 500. We're up to 80% despite continued weak economic data. We're up to 80% on a 25 basis point hike at the next FOMC meeting on May 3rd. A bunch of the Fed heads have been coming out saying, yeah, we'll do another 25 and then we'll see. These people don't live in the real world the way we do. Um, Expectations remain positive as long as we're above the 21-day exponential moving average, and we are on the S&P and the Nasdaq 100. As far as different levels, in a tight range today on the S&P. We touched this fib, as I mentioned, on the Nasdaq 100 and bounced off of there. So that's also a good sign. Here's the various trends during the day, the ranges, the dollar strong, ITB strong, XLF strong on the back of JP Morgan's earnings. Some things that started strong and then failed. KBE uh, down 1.1%. Also KRE, as I said, down 2%. Oil started strong, closed mixed. Semiconductors started strong and closed basically flat. So some disappointment as the day wore on some things that were strong early. To the downside, gold and gold and silver stocks, ITA down. Biggest component of that is Boeing, which ended up down 5.6% on parts issues, slowing deliveries, which we commented on yesterday. So in-house in the portfolio, we added to ONO, and it showed massive volume and strength early. And by the end of the day, TMDX showed no signs of recovering the 50-day moving average, so we cut that loose. Basically, portfolio adjusted beta staying at 1.1 uh, relative to a 1.0 S&P 500. Bottom line, red finish to the day, but a green support week for all 5 of the indexes, and in fact, flat on the S&P after hours as the futures continued to chug higher, carrying the SPY and the S&P with it. Okay, so that wraps it for the tail of the tape. Let's go to the 21 over 21 list. And, like I said, leaders not acting great. Uh, Keep an eye on the relative strength line on these. There's just a few where it continues to go higher. So if it's going flat, that means it's doing what the S&P is. That's not what we want. We want leading stocks to be outperforming the S&P at least by a factor of 2. And they really aren't. So we're going to start off with first the 2 that we dropped this week. TLT was on here, that broke the 21. Disappointing action there. And 4 payment processing, shift 4 payments, very volatile. Don't like the volatility at all on this one, making a lower low and breaking below the 21. The 2 that we added, ITB. Now we got shaken out a nail, and this is very typical of what this market's doing. We bought this breakout on 331, 1 day higher, 3 days down, breaking the key moving averages, rally into the key moving averages, which is normally, if the trend's going to continue lower, you'll roll over here. But we didn't roll over. On Tuesday, we gapped up and then consolidated for the rest of the week. So ITB, home builders have been constructive, showing relative strength versus a lot of other sectors that are weak. So we're putting this as a proxy for a bunch of home builders that have very similar charts uh, on adding it to the 21-21. Second one is race. Alex, former Revere employee, still a consultant for us, is long this. This is just a nice chart. It's been, again, showing relative strength. You don't see a lot of leaders doing that. So relative strength and good price action on race. I guess there is no recession for the ultra wealthy that continue to buy these cars. They've got a big backlog. So the rest of the 19 survived from last week, some undercut and reclaimed. Let's go through them. SE sitting on the 21 most of the week. FedEx going sideways all week after its earnings gap. A little bit of a trend lower for Mondelez, but still holding the 21. GDX stocks stay strong. Gap down today, bounced at the ADMA. ExxonMobil. This is a proxy for really a lot of oil stocks have the same setup. The gap up on OPEC cutting production, going sideways for 2 weeks. We own NRGU in-house, which is an enhanced 10 big oil ETF stock. Pretty much the same setup on that. Rambus continues to be one of the strongest of the semiconductors, as semiconductors on a whole have been showing relative weakness after a nice run to start the year. Rambus going sideways to higher, looks good there. We own that. Lulu, 3 weeks tight after its earnings gap up. Let's see if it can break out of the 3 weeks tight next week. ELF, this is one of the few leaders that continue to plug higher, and kick myself for not getting back into this. ONON, we added to this today, closed in the bottom part of the range, but this is consistent with the Snapchat breakout of October 2020, almost bar by bar. Very consistent as long as it's hanging above the 21 and now above the ADMA. We're happy with that. CDNS continues to trudge higher, but really just about in sync with the S&P 500. PagerDuty choppy, undercut, but reclaimed by the end of the week. Wingstop, another one that undercut but reclaimed by the end of the week. Meta continues to ride the ADMA higher. GE Healthcare pulled back to the 8, bounced off of there, continues to show strength. Axon just riding the 21 EMA sideways. Lantheus, relative strength and riding the ADMA higher, coming into its pivot plus 20% area. Palo Alto, we got shaken out of this on what was looking to be a second day below the 21. We sold just about near the bottom. It had a big pullback today to the 21, bounced nicely off the 21 and is into this 200 area, which has been resistance. NVIDIA, relative weakness, but bounced twice now off of the 21 over the last 2 days. And finally, GE, which continues a little bit of relative weakness, but um, just going sideways over the last 2 weeks. And that's going to wrap it. That's your 21 over 21 list. As always, would like to hear from you. Again, the email is don@revereasset.com. And remember, of course, it's not how much you make in the market, it's how much of that you can keep. Reach out to us with any comments on these videos. We do listen to them and we do act on them if you come up with a good suggestion that we think would benefit the listeners. So uh, always open to hearing from you. And with that, I am going to wrap up the week ending April 14th. This is Don Vandenbord with Revere Asset. Nothing but market facts here from Revere, telling it like it is. Thanks for listening and have a great weekend.